Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, August 29th, 2019. I figured this is probably about as good a time as any to do another video. The charts I'll cover here, let's just stick with what I covered yesterday in the last video of the day, covering the equity markets, gold, and treasury bonds, the risk-off assets and the risk-on assets. And the charts I'm going to go over today will be the same ones I went over this morning, but I just wanted to, share some of my thoughts in there in addition to just the levels to watch. So first up is QQQ 60-minute chart. As I posted this morning, we're right, gapped right up to that downtrend line. We're right on it now, give or take. You're a little bit above, a little below. Also remember, a gap is the ultimate form of a momentum-fueled overshoot. So, you gap up to a level like that, you're going to overshoot a little bit. And, of course, as I mentioned, I had price resistance right above it, that level right here. You can see lots of reactions in the past on that 188.37. And then bigger picture remains, we're still within the trading ranges. Now, I've excluded this little blip here because we have a lot of reactions down on that level there. So really these blue lines here, 189.40. So one of the things I wanted to reiterate is, and I also said this, I believe, in one of the comments sections this morning, maybe it was that front page post, either that or under the comments, that again, this is an objective shorting entry because we have popped it back up to a resistance. Anytime you're in a trend, whether it's a downtrend like we have been off the highs recently, or at least a trading range, either way, and the MO has been to, short the bounces back to the top of the range or any of the resistance levels within. Sometimes example, you've hit 188.37 before, or the downtrend line, of course, that's what's capped all advances since the highs back here. So on that aspect, it is objective now, but objective, as I said in that post, the word or the term objective and high probability are not one and the same. You can have an objective entry on a trade that I also call a high probability. When I say a high probability entry, I mean high probability of success, that I have a very high degree of confidence. But those two can be, but don't have to be, mutually exclusive. In other words, this one, as I said before, I didn't want to see, for the bearish scenario, it would be better if we didn't make another run at these highs again, the top of the trading range. This has been a long, unusually long trading range right now, based on what's happened. I mean, I've seen much longer trading ranges in the market, but in compressed in this space, especially in light of all the bearish technical developments, the divergent high, the impulsive breakdown, everything else, again, it's a little quirky, if you will. And so what that does, you can hear my voice, it gives me a little pause. And like I said before, when we were down here, I really didn't want to see it, but it's not the end of the world if you get back up there. It doesn't take out the bearish case. The bearish case really starts to erode when you take out the top of that trading range with conviction. So there it is. So again, objective, you short that trend line. If you can, depends on how you're already positioned. If you have dry powder that you are looking to short. Would I go long? Well, it's not objective to go long. Why? Because you're at resistance. TA 101, Trading 101, in Technical Analysis 101 says you do one of two things when a stock rallies into resistance. You either wait for a breakout above the resistance. In this case, since I have a price resistance level just above the trend line, on top of that, you have to be a little skeptical of momentum-fueled overshoot. Therefore, essentially, you're still at resistance, and unless you take that out, then it's what I was getting at is TA 101 says you either short a bounce into resistance or you wait to go long on a breakout of resistance. But you don't go long at resistance. That's just, again, contrary to trading. So that's that. And then, as I said, this is only about, from the highs today, it's only about another 0.5% or so to the top of the trading ranges. So, you can short here and you would have a stop somewhat above that level. I'll say this, and I said it earlier today, the markets spent a lot of energy just to get up here to the gap. That's about from where we closed yesterday to the trend line. I should say to the trend line, not the gap. That's about 1.65. So at today's highs, they were about Yeah, let's see. I'm looking at my pop-up box to the left. It shows me, yeah, about almost 1.8% up at the highs. That is a big move for QQQ. Again, I view that as, fuel. You spend a lot of fuel, you're going to have to, recharge your batteries at that point or refuel. And so therefore, the odds of us going up another 1.5%, like it's not even there, are very low. So I think the best case scenario for the bulls would be some consolidation here. If we happen to go up to that level, maybe come in and back test. So again, that's only another 0.5% from the high, so it wouldn't be much, but that would be about it. There are no certainties, but I would put a high degree of confidence that the upside from this point, from today's highs, are limited to about 0.5%. And therefore, it's objective to short for a pullback trade. Might not go far, but you may get stopped out. But again, if you get stopped out, you're risking 0.5% to make what could be, if we run back down to the bottom of the channel, many times that. And at the very least, if you're looking for what would be a likely near-term target, if we get rejected here, move back to that 186 level, 186 or so, and quite possibly a backfill of the gap. Again, that has been the MO of this trading range, these big moves. Everybody wants to get bullish and say that the market's going to go to new highs and cover their shorts here. And then when that happens again, everyone wants to get short and saying we're going to break down. So, we're up today. And again, it probably feels no different from these moves. Although, like I said, this one's a little bit different again to me because at this point in time, this market, it should have broken down, quote unquote, where expected. It just shows it's been very resilient. That resiliency may prove that we break above the top of the range, but let's leave it at this. Again, resistance is resistance until unless taken out. So let's see how today resolves. And if you're not sure what to do, because again, I made it clear, this is not a high probability short trade, nor would it be a high probability long trade if we do break out there, or even break out, anytime soon above 189.40. I would not consider that a high probability long trade either. More of a, hey, step back, something's quirky with this market, see what's going on, or at least the way, my interpretation of the technicals. SPY, yeah, there's a downtrend line off the high. SPY gap just slightly above it, but again, clocked hard at that 292.25 level. Look at the candle right there. The candle body closed right on it. Again, next candle opened right on it, and so far has rejected. So we're bouncing between, and that's again why I always say if you have two resistance levels close by and you're looking to go long, this is your BOD line, benefit of the doubt. You need to see the second of the two break. You go long on the breakout of the first one, you're likely to fail at the second one. So again, this is what the bulls want to see, solid breakout and move above 292.25. But again, we spent a lot of energy, or the SPY did, just to get up to that point today, and so it may need to compress for a while. Now it's doing that also, by the way. I should mention, since we've opened, it has been compressing. That helps to work off the very near-term overbought conditions, and the longer it does that, the greater the chances are that it could then go on. But this can go either way. So, micro level, you can look at it this way. You have this little trading range right here. I probably wouldn't put too much of weighting in this. In other words, can break to the upside and we might rally, break to the downside, we could go on and backfill that gap. That'd be a nice trade if it is backfilled. And again, that's what I always talk about, risk versus reward. You got about a 1.1% downside on SPY, even bigger it should be on the Qs. From here, as I'm doing the video, to yesterday's close, that's right here, the dotted or dashed yellow line, that's 1.5%. So if you were to get a backfill of the gap, you might want to cover a little above there, probably around that level, the 185.25. You're talking 1.5%. Whereas if you have a stop above today's highs, you're talking maybe a little over 0.5% or so. And so again, that's what trading's all about. And of course, if they backfill this gap, and if they do it soon, then it's going to be pretty ugly knife through the heart of the bulls. Remember, we had a big move up here, like I talked about, to the top of that trading range. Big gap right here. Remember that? And then boom, we backfilled it, and that was again a knife through the heart of the bulls. push back up to resistance, the same level we stalled at today. I see a lot of story, a story to be told, a lot of little smaller stories, that occurred in here at that level, battleground, if you will, between bulls and bears, at this level many times in the past. And so there we are again. So what I was getting at, if we do backfill the gap, that undoes everything that we had today, this big gap up, which supposedly the headline was just, to me, it's asinine. It's beyond ridiculous, that China comes out and just says, oh, we're not going to retaliate. The market is hanging on any little word or any little development for the trade wars. And so that's not any progress on the trade wars. They're just saying, okay, we just exchanged a few blows back and forth, the U.S. and China. So we're not conceding to anything. We're not making a deal. We're just not going to fire back another blow. Well, to say, guys, no shit. I mean, the trade wars are getting, at this point, the most recent salvos that both U.S. and China fight have been pretty heavy. I mean, what do you, of course, it's not going to progress much beyond that right now at this point in time. Obviously, it's to the, benefit of both countries to not, outright destroy each other in this process. But anyway, that's just me digressing. And just the fact that I'm amazed that the market viewed that as such a positive event. Thank gosh, I was, last night I told you guys that I didn't expect much to happen in the futures overnight because of GDP. And so what happened is, remember I told you I reversed here yesterday, was long into the day and then reversed at that 7,600 after a little fake out move, and then after the close we got a nice reversal. So I reversed back because the trend has been a mean reversion, especially again I didn't see a big move, so I was able to get back into go back from NQ and RTY short back to long again. Put a stop in place, and I woke up this morning very pleasantly surprised. Got out a bit early because right when we hit that 76.96 and downtrend line, these are the levels that I'm looking at on the futures right here. That's that well-defined trend line. And by the way, it's even better defined than in the index ETFs because again, in futures you're trading virtually around the clock. So you have 4 distinct reactions there. 1, 2, 3 distinct reactions there on the 60-minute chart, and now another one. And again, nothing so far, at least, knock on wood, but a momentum fuel overshoot. So I've, went, covered them there, reversed it again, and I'm short right now because again, it's all about risk reward. I'm not, as confident as the last time around, so I have a smaller position, and I had a small one last night. It was nothing big to take home. It's not worth going home heavy, long, or short right now. But so far, see where we're at, 77.06. That's right at now 70. Well, yeah, right at about that. We'll call it 7,700 level right there. So price resistance, and then as if not more importantly, the top of the recent trading range just above there. There's our trading range. When a lot of reactions around this level. I have that line at 77.50, but we do have a few reactions a little bit higher than that. So that's it. And there's one more thing I wanted to talk about on the FANG stocks, and then maybe gold and treasuries real quick. But to wrap up with the futures, we have, of course, ES, same story. Price resistance about 29.15, and we're just a hair above it now. We're talking 4 points or so, 4 or 5 points on a 3,000 point index. That means basically you're right there. Zoom in tight. So we had again a momentum fueled overshoot, as all this has been so far. And when I say, spent a lot of energy to get there, remember we were already somewhat in an uptrend. And as I showed you this morning on the charts, I covered both NQ and ES. You can see we're overbought, and just trading is all about probabilities. There are no certainties. It's like playing poker. You play poker, you look at your hand. I like Texas Hold'em, one of my favorite games, and you got to figure out, okay, you see what's on the table, so then you know what you have, and you have to then do the probabilities on what your opponents might have based on the down cards you see on the table, the 5 cards that are in play. So there's that's the overbought readings. So again, looking at just pure probabilities the likelihood of ES and NQ going up much more than this are just not very good, you know. And especially these were in the downtrend, like I always talk about. Overbought tends to become more overbought or stay overbought, or you have these clusters of consecutive overbought readings in an uptrend, in a bullish trend. But in a downtrend, so far we've been moving down off the highs here. It's not a clear downtrend because of the recent trading range, but you can see, you know, there's our downtrend line, and here was an uptrend, right? So my point is, that's why I've circled these, because overbought tends to become one and done in a downtrend. You hit it and that's it. Usually you reverse, you don't get much more overbought. You might notice that I have my line at 84. You might say, well, Randy, isn't overbought 70 on the RSI? You know, in the textbooks it is. Most people use that, but I treat every security different. That's why I'll replicate, or sometimes you'll see different levels on my RSI lines. And again, it's very easy to me. I look back and when was ES overbought? Where did the line stop? Where did things reverse? And it's right around that line I put there at about 84. And the point was, here is an uptrend. So even then, if you shorted it, you know what? You didn't really go much higher. You had a couple tags. I mean, ultimately you worked your way up, but at least you got an initial pullback. That's what I'm talking about here. And even if you didn't, if I had gone back on this chart and seen an overbought reading, well, maybe this one here. Yeah, here. Okay, here's an example we used. Let me make sure the line is aligned here. That overbought reading was right there. Okay, so you had a correction. You sure did, a little bit, very little. Probably not even enough to hit your target. And then we went up. So that one didn't work. And again, my point was, you're in an uptrend, so you don't really pay attention so much or put as heavy a weighting on being overbought during an uptrend. But in a downtrend, overbought, as I just showed you, is usually a gift. And when you get it, I take that gift. So that's again why I, you know, reverse back into shorts again. Okay, and IWM, you know, I gave you guys yesterday 3 targets. Both T1 and T2 were hit today on the gap up, and then again, and I'll tell you now, based on the analysis I'm telling you on SPY and QQQ, and there's a point I want to get to here as well, again in a second on the FANG stocks, probably not going to see T3 hit. You know, like I said, I reversed. I didn't have SPY, but I had ES and, I'm sorry, RTY and NQ, and I'm talking my active trading account. By the way, you know, my IRAs, and those are longer term accounts. Those are still with swing shorts. I have, I'm long the VIX. I'm short the equity markets. I have other things in there as well. But for the active trading account, this is what I'm talking about. So I don't want to, you know, come across, get you guys confused. I'm still longer term, still favoring that downward break, or at least intermediate term. This is just near term stuff, you know, an active trading account, in, out, long, short, all the time, depending on these, you know, these intraday charts, sometimes even the 1 and 5 minute charts. But there it is. So IWM has hit that second target, and that's probably going to be it. Now, here's where I wanted to go, and this is why I wanted to do the video and convey my thoughts. And I did mention this on on one of those front page posts this morning in the comment section, or maybe it was under yesterday's, last night's, yeah, it was under last night's video. All right, the point that I'm making here is that if the recent highs in the market, talking the broad market in general, was a significant top, and we are going to take that next leg down, that I'm still leaning towards, a little less crazy about today, that in fact we're up so high, but again, that's still my preferred scenario. If that is the case, then what I would expect to happen is nice looking bullish setups like this, like IWM and those FANG stocks. I'll get to those in a second, that I covered yesterday. Remember, we had a lot of those, like Amazon at support with bullish divergence. In a bull market, this is a gift. This is what I look for in a bull market, especially during corrections, to, you know, to reverse my swing positions, my swing short positions, cover my longs, cover my shorts and go long. One of the things I look for is bullish divergence, even better when you have it, the market or whatever you're trading down at support, ideally the markets. And that is, again, what I like to look for. And that usually sets the stage for the next leg up, and often going on to new highs, or at least a swing tradable trend. What do I mean by a swing tradable trend? I'm talking about a trade that I'm not going to measure in hours, or maybe just a few days, like I have been lately, you know, with these, you know, active trading in the 60-minute charts, within the range, that is. but more so a trend that I would expect to last for weeks, possibly even months, and probably measure into the high single digits, maybe even double digits as far as the gains go. So that would be if and look, this is yet to be proven. I mean, we're still in by longest term trend indicators of bull market. We're not far off the highs at all. So nobody can tell you that we're in a bear market or that we're in a much deeper correction, even if it's a bull market with new highs to come. Nobody can say that yet. Again, we're too close to the highs. However, this is what I'm watching. This is what will give me some insight to where the market might be headed, not just today, tomorrow, but over the coming weeks, maybe even months here. And that would be if these beautiful bullish divergences, this nice setup right here, fails to materialize. You can see we have the downtrend line that comes in. I was showing this on a 60-minute chart yesterday, and then I added it. The first chart I posted didn't have that, and I added it this morning. You guys can see that one on the front page. So this is what looks like a falling wedge pattern. At least you have a downtrend line there, and so yeah, that would project, if you take the widest part of the wedge, that's how you get a measured target for a wedge. You just simply take the widest point. Let's just ballpark this right here, and you add that to where the wedge breaks out, and that gives you a rough estimate of the measured target. So that would bring us back up to that key level right there, about the 156.50 50-ish level right there, right? Now, if it doesn't, then it's a clue to me, a big clue as a matter of fact. If this bullish setup fails to materialize, and you might say, well, it did. No, that's just a little blip off the bottom. It was nice to catch. I put some pretty pennies in my pocket yesterday. I hope some of you guys caught it too. But that's no different from this so far. It was just a rally up to here. And so if we fail to break out and go much further, and we dump and we go a lot lower after this, that is a tell. That tells me, hey, we're not really in bull market mode, at least not the bull market we've seen for a while. That is a tell. And because in corrections, or especially in bear markets, bullish chart patterns, bullish setups tend to have a much higher failure rate. Either they break out and then fizzle out and it's a failed breakout, or they don't even break out at all. That's bear market action. Just like in reverse, goodness knows I've had my share of bearish chart patterns that I've taken shorts on and they didn't play out because the market just turned around and went up, and that's part of a bull trend. Bearish chart patterns have a much higher failure rate, even if they're textbook looking, bullish falling wedges. You got your divergence, impulsive breakout, everything I like to see. Sometimes they do play out, and you have to just kind of measure that. But and when you're in a bull trend, you just keep your price targets to the smaller side instead of trying to go out for the big gains. But again, that's typical of a bull market, where those bearish patterns fail much more often, and bullish patterns like wedges, for example, will often go on to exceed their measured target. They're usually the catalyst for the next major leg up. So again, that's what I'm watching on IWM, as well as those market-leading FANG stocks. Remember, I did the video yesterday. Amazon's one of them. You have the nice, clean bullish divergence. You have a very important support level right here, well-defined. And by all accounts, if we're in a bull market and we're going to new highs, this would be a great stock to buy. This one's at support, 60-minute divergences, and it should, quote unquote, should go on to break out. It needs to break out above this 1831-ish level. You can see it's the recent trading range, and this is because the market's been in the trading range for all of August pretty much. So is Amazon. So this is what should happen, and most likely will happen, if we're in a bull market that has new highs yet to come this year. This is what's probably going to happen if I'm right, and we have another leg down coming, and you'll see this whole thing will break. It'll break to the downside. These divergences right here will just fail to play out. And when will you know that? Well, once they're negated or taken out. That means here's your previous lows right here. Divergence is simply prices making lower lows and the indicators making higher lows. So once your indicator takes out that previous low, if the MACD or PPO comes down here, RSI comes down here, then you no longer have the divergence. So that, to me, again, would be a pretty important tell. could cover treasuries, but again, I mentioned that yesterday. It's it's two things. It's a hedge trade. Somebody asked that question. I answered it this morning in regard to under last night's video in the comments section. Was this? What are your thoughts on this? Well, it's two things. It's first off, it's a straightforward setup. If you want to just do a pure play, forget about whatever else you're trading. There was the trend line break. We broke down. We hit that first support level, 146.31. So it's a short setup. It's treasuries have been extremely resilient, but they're not going to go up forever. Sooner or later, they will correct. And so far, we have a decent pullback. That's one of the biggest drops we've had in a while. 0.83% drop on TLT. And again, the case was made. So I'm not going to spend a lot of time on this chart. And it's also the other thing about it too, as I said in that answer to that comment, is it is what I call an indirect hedge to a short position on the equity markets. What do I mean by an indirect hedge? Well, if you're trading SPY or QQQ and you're short the markets via any of the index ETFs, a direct hedge, if you're short QQQ, would be to buy calls on QQQ. Because the calls are options that will benefit or they'll go up in value if QQQ rises. So the purest play, a direct hedge to a stock or an ETF that you're trading, is a put or call option, depending if you're long or short, because that's almost a one-to-one hedge there. Not counting the whole volatility premium thing. An indirect hedge is this because treasury bonds, quote unquote, should or at least usually do move inversely to stocks when the stock market rallies. And if it does, let's say we take out those levels, we break out of the recent trading ranges in the market, equity markets. Let's say we do this, here's our trading range. We're right up here now, getting close. We break out. I can all but assure you this is going down. The only way we're going to break out is if the consensus, the general public, the majority of market participants believe that the fears of a recession, at least for the time being, have abated and the economy is going to continue to be strong. Therefore, stronger economic growth means lower or higher treasury yields, which means lower bond prices. TLT goes down, remember, when rates go up. It also means that the Fed would then back off. They might not completely back off their plans to higher rates, but the dot plot, or the expected trajectory of interest rate decreases, would certainly back off as well. So I can tell you that again, and you see another, let's say 3, 4, 5% upside in the market from here, treasuries are going to go down, most likely. Can't guarantee it. And I say that again, an indirect hedge, because we have been in a very unusual situation, very unusual, where treasuries have been very strong, rallying with stocks throughout most of the year, and that is not normal. And it's been talked about by myself and many others as a red flag. They say of the two, you can Google this term or read up on it, or if you've traded long enough, you've probably heard it. Of the two, the bond market is almost always right, more so than the stock market. So the bond market's screaming, hey, something's wrong here, where the economy is going to be slowing down a lot going forward, and that's why treasury bonds, long-term treasuries especially, have just rocketed. But yet the stock market, meanwhile, is right off its all-time highs. This is here the rally so far this year. We're not far off the highs. That is a big disconnect. There will be a mean reversion. So I feel very confident, although again it's not a direct trade, because so far this year treasuries, instead of falling when stocks were rising, were also going up. But I think if we break out, I think it's safe to say if we do this TLT at this point, especially as overbought as it is, plus with the bearish technical case I laid out yesterday, would do this. And so therefore, that's how, again, I'm viewing that as an indirect hedge, meaning if you're short stocks, then you've lost on those positions today or down on those. But if you're also short treasuries, you're positive on that. And the way to, the final note on that, I gave you the targets for TLT. TBT, if you don't short, you want to just go long, if it's an IRA or something like that, you can buy TBT. It's just a 2-time inverse. You just have to correlate your targets. That's not hard to do. Just take the same levels. I haven't updated this chart in a while, but you can see we have, instead of negative divergence, we have bullish divergence, and you can see here, I'll give you all the levels right now. 1, 2, let's just leave these for now. These are near-term targets here, and this would be a that, remember I gave you yesterday more of my max downside target. That would be somewhere in this range here, about the $28 range. And that would entail most likely the stock market breaking out above these recent trading ranges. So, and I think that breakout, if it does happen, which again, possibility is certainly there, probably at the same time or right about there that the stock market breaks above the August trading ranges, you would see TBT break out above this 2470-ish level, and then do something like that there, run up there like that. Oh, and then one more thing, and we'll wrap it up here. If you were to take an indirect hedge on treasuries, let's just go back to TLT or ZB, Treasury Bond Futures. Remember that treasury bonds are inherently much less volatile than equities. So therefore, if you have, let's say, $50,000 in short QQQ, and you think, okay, I like it, I want to take the TLT as a hedge. You don't short 50,000 of TLT. You short 100,000 or more, because TLT on a good day or bad day is going to go up maybe 1%. Not that it can't go a little more than that, but as you know, on a good or bad day, QQQ is going to go up 3% and could go up more. So it's almost about close to about a 1 to 3 ratio there as far as the daily swing. So therefore, you can take 2 to 3 times the amount of a short on TLT. Again, if you go to TBT, it's already leveraged 200%. So therefore, almost a 1 to 1 or maybe 1.5 to 1. Again, if you wanted to, depends to what degree you want to hedge. Sometimes I'll talk about being fully hedged, partially hedged. Fully hedged is a 1 to 1 hedge. Partially hedged means maybe you're, net long, you have, let's say, 100,000 invest and you have 75,000 of it short and 25,000 of it's long and something else. That would be a partial hedge. All right, let's wrap it up here. And again, just watch those levels, and if you're not sure what to do, today's a good day to probably sit back and just see how this battle is resolved. This is make no mistakes about it, this is a pretty important battleground right here between the bulls and the bears, right from where we're at now up to about the top of those recent trading ranges. And I'd like to say winner takes all, but who knows? I thought it would happen when we got up here, that once we got down, we'd break it. So we're in that trading range. So until and unless we're not, that's what we have to watch. Okay, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.